Oh, I hope you had some interesting networking and some more interesting discussions on AI. And we're going to now move into our last session for today's event. And we're going to invite Eric Ball to talk about why you should be ahead of the game and invest in venture capital at times like times like COVID-19. So I'd like to give the floor to Eric. He's the co-founder and general partner at Impact Venture Capital. I know that Mamoun has already introduced him and that Eric himself gave some more information, but he is a tech finance professional, an investor and a board member. He chairs the audit committee at Glue Mobile, which is a publicly traded leader in 3D freemium mobile gaming. He's a board member or an audit committee member at Socati, which is an ag tech private company in Austin. And he chairs the board of capital market startup Cat Connect Plus, which he co-founded. And he serves as a board advisor to Kariba Corporation, which is a leading provider of software for treasury and cash management, and to several other Impact VC portfolio companies. So Eric, the floor is yours. Eric, maybe you're on mute.
You know, no matter how many times I do this, I struggle with that most basic step of turning on my microphone. I want to thank you, Jane. I've really enjoyed the discussions in the breakout rooms and a chance to get to know people in smaller groups. Today, I want to take a few slides and go, probably through too many slides, so I may go rapidly, but I'd like to share some of the information that Jack and I and the team at Impact Venture Capital consider when we think about the current environment in this age of COVID for venture ecosystem, both regionally and globally. Jack and I founded Impact Venture Capital in 2016 to drive investments into early stage applied AI startups here in Silicon Valley and elsewhere. I want to talk about how the data has indicated that this is a promising year to deploy capital into venture as an asset class, and describe the critical role the corporations and their venture arms are playing in the growth of the venture ecosystem worldwide. If we could go to the next slide, I'd like to start by looking specifically at the ecosystem here in the countries of the Gulf Cooperation Council. You know far better than I, one more slide please. You know far better than I the local environment, but let me point out some of the challenges and opportunities that I perceive from my own vantage point. Several years ago, a prominent Harvard business professor estimated that it is 5 to 10 times more difficult for a Middle Eastern entrepreneur to achieve break-even than it is for an entrepreneur in the US or the UK. He gave familiar reasons: property laws, inconsistent infrastructure, markets geared toward family business, and inconsistent levels of a risk-taking mindset. Another challenge is that almost 2/3 of early startups in the region are found in just 2 countries, the UAE and Egypt. A third challenge is that 2/3 of funding comes from the family of the founder and only about 6% from traditional venture investors. Lastly, the GCC, like the rest of the world, is managing the economic fallout from a global pandemic. If we look at the next slide, we see some reasons for more optimism than I just described. You know better than I why the barriers that were described are falling each year since Professor Gosh made those observations 7 years ago. There are more institutions, both government and private, making the development of the local venture ecosystem a priority. If you look at the Board Directors Institute itself, you've grown to 1,700 members, reflecting a real enhanced emphasis on both mature companies and young companies. I was grateful to be there in person in the fall of 2018 when the Crown Prince of the Kingdom of Saudi Arabia launched the Future Investment Initiative. This year, 5 GCC countries scored at least a 3 out of 5 in the MIT Enterprise Forum's Entrepreneurship Maturity Index score, representing a growth in the investment friendliness of different jurisdictions within the GCC. And funding is increased. If you go to the next slide, you'll see an example of how 67 startups in the Middle East received about $67 million in 2015 to 6 times that number last year, with a further increase this year, showing that the GCC is proving more resilient to managing the challenges of COVID than our other regions and countries. The first half of 2020 had about the same pace of deals as the entire year of 2019, but at a higher average amount, so that the amount in the first half of 2020 in dollar terms was about identical to the amount for all of 2019. So it looks like not even the virus can stop the growth of venture and the formation of new companies in your region. Now I'd like to go to the next slide and take the focus away from GCC to the US and the world. I start with the observation over the past 30 years, no asset class has had higher returns than early stage venture. Under shorter horizons, the asset classes have clustered returns. Over longer term, venture outperforms, and early stage venture as a distinct asset class outperforms even late stage venture as you go out to longer horizons. As we go to the next slide briefly, here in the US, venture investment was increasing before COVID. It's fallen this year, but the trend was up absent the rude interruption of the COVID pandemic. But that has created some other changes. If we go to the next slide, we show that the risk return advantage of early stage venture is more pronounced in a crisis. This is because conventional asset classes suffer. This year, in the wake of COVID, we have seen in the US, the stock market, represented here by the S&P 500, is approximately flat. But that hides the fact that over 80% of stocks are down and only 20% are up. The 20% are up a lot, compensating for the 80% being down a little. So you see an index that looks flat, hiding a much choppier underlying fact set. And that's really shown on the adjoining slide, which shows the volatility as measured by the VIX has spiked this year. So stocks in the US are a lot more volatile than prior years. And if you go to the next slide, we see that outside the US as well, where an index of all non-US stocks is down and volatile this year. Real estate is down and volatile this year. And fixed income yields are very low, or what I like to call reward-free risk for keeping your money in the fixed income markets. So when we go to the next slide, we see that as a backdrop why private company valuations tend to create opportunity in a crisis. Valuations are often lower in a crisis year, and by the time the companies mature, the crisis has passed, and those lower valuations translate into higher multiples. We looked at data from 2008, a year that gave birth to several prominent startups in the middle of the financial crisis. As a vintage year, 2008 turned out to be the second best year of that decade, and we see similar opportunity in this year's crisis. This is borne out in the next slide by a more detailed analysis of 4 different past crises over the last 30 years, which show that the best time to allocate to venture capital, especially to early stage venture as an asset class, tends to be 1 to 4 quarters after the low point of a crisis. The conclusion that we at Impact Venture Capital has reached is that at the start of this year, and that we still reach today, is that whatever your long-term average allocation as an investor was to venture as an asset class in 2019 or the beginning of 2020, we think that an analysis of how this market has behaved in past crises indicates that you may want to increase that allocation here at the end Q4 2020 and the beginning of 2021. I want to switch from why venture makes sense in a crisis and talk about the corporate element of venture capital. In the next slide, you can see some statistics around corporate venture, and a core part of our identity at Impact is our strong collaboration with corporate venture arms. I used to manage Oracle's corporate venture portfolio, and I engaged Jack, my now partner, as a consultant to assist me in 2012. When we formed Impact in 2016, fewer than 1 in 10 venture deals included a corporate investor. Last year, more than 4 in 10 deals, almost half, at least in the United States, had a corporate investor. And so corporations have been the primary driver in the growth of venture dollars in the ecosystem around us. Often, corporations and independent VCs have differing objectives. Here at Impact, we have sat on both sides of that table, and we are convinced that we are seeing a stronger quality and quantity of deal flow through our partnerships with major corporates. At Impact, we've co-invested with many corporates, including SK Hynix, Yamaha, Baidu Ventures, Goldman Sachs, Bank of America, Datalogic, and several others. If we go to the last slide, then I want to finish by sharing what we take away. Oh, I'm sorry, one more slide. I'm editing my presentation as I go. I want to show what we at the firm take away from data. We are an early stage applied AI-oriented tech venture firm. We observe that funds that are modest in size and invest early in the life stage of a startup can achieve higher multiples on smaller initial investments. We see artificial intelligence as a tool that's making all businesses more efficient, much like the internet did 20 years ago. And we have as a core part of our identity strong partnerships with corporate venture arms where we see a better quantity and quality of deal flow. Some of our own corporate investors have chosen to be LP investors in our fund, and others simply co-invest with us into specific portfolio companies. We are currently planning to close our own Fund 2 over this quarter, and happy to share details with any of you who would like to learn more about our own approach to investing in early stage startups, particularly in applied AI with corporates. I'd like to pause there and save a few minutes to be a little bit more interactive and address any questions that you might have about how we're seeing the environment from our vantage point at Impact.
Eric, thank you. There's a question saying, based on the current environment, other than tech or AI, where do you see other opportunities?
Well, I spend most of my time with tech and AI, but I see opportunities there. There are a lot of opportunities in sectors that are getting a tailwind from COVID, and that's actually broader than you might think. The obvious examples are companies that promote remote work. You know, Zoom is an example that everyone likes to talk about. We have a portfolio called TaskHuman, where they're using a teleconference platform for people to engage with coaches, whether they be fitness coaches, mental health therapists, dietitians, nutritionists, different people that can help one lead a more healthy lifestyle. They've established a teleconference platform there, and that's a great example of a company that we're seeing a really great tailwind in the COVID crisis. We have two capital markets oriented companies that are also seeing good tailwinds because in a crisis like this, a lot of major corporates are borrowing more money, they're staying more liquid, they want to have more cash, and they're more active in the bond markets. We have a company that's active in primary bond market issuance, Cap Connect. You heard from Suresh, who's the chief operating officer of that company earlier this morning. And we have another company called BondClick, which helps make secondary trading in corporate bonds more efficient. Both of those companies are benefiting from the increase in liquidity that's being driven by the COVID crisis. I think healthcare is an obvious winner in the current environment, and we see some intersection between AI and healthcare. We have a company called Syntegra, which is the first company from our Fund 2, which is using machine learning to create synthetic medical records to allow pharmaceutical research and insurance companies to learn from large populations of useful, actionable medical information without violating the privacy of specific individuals. And their first user for this tool is the Bill and Melinda Gates Foundation, which is playing a leadership role in the fight against COVID here in the United States. So I'd say that the COVID tailwinds are you're seeing not just in remote platforms, but you're seeing in capital markets, in other parts of fintech, you're seeing in digital healthcare. There are a lot of investment opportunities that we're seeing this year.
Eric, thank you. I think there's a question here about cryptocurrencies. So maybe a more general question for you in terms of your perspective on cryptocurrencies. And then I don't know whether there's a question about cryptocurrencies in the region and halal cryptocurrencies. I don't know whether Vinay could add anything on that. But Eric, cryptocurrencies, what's your view?
I think cryptocurrencies are exciting. I do think they've sucked up some of the oxygen in fintech. And so we've been active in some elements of fintech that don't involve cryptocurrency and that I think have been getting a little bit more visibility, after some of the boom and bust nature of cryptocurrency. So the capital markets companies that we've invested in, we're seeing a lot of payments companies, fintech startups in the Middle East, some of which involve crypto and some don't. Having said that, I think crypto is still a great opportunity, but I think that there hasn't really been standardization in blockchain and crypto. One of the things that excites me about what Dr. Conley was talking about earlier was the possibility of getting a blockchain architecture which can achieve consensus with fewer nodes. And that sounds very technical, but what it means is that it becomes efficient to transact at very low amounts. And so instead of transacting, it costs about $3 to process a check. It costs a few cents, I think, to process blockchain. But the platform that John is building can process a transaction for a small fraction of a penny. And I think that could enable a whole new economy in micropayments. So I think there's some really interesting activity, but I think that that there's no real standardization yet. You have different cryptocurrencies built on different platforms, and I think that the real growth will happen when the market picks some winners that everybody can standardize around.
Eric, thank you. I don't think that we have much information on halal cryptocurrencies or those without interest in the region, but maybe that's a topic for another time. I think that it's not a big thing in this region right now, but listening to you, maybe that's an area for opportunity for the future. I think there is a question further up. I'm just looking here. Sorry, there's a question that I know that I've missed. Yes, a question here from Sofian saying, are you looking for investors in this region or to fund startups in fintech and AI in the region? Or both?
Well, I would say yes, but we'd like to be sequential, which means that we are open to investing globally, but we tend to wait until we have investors ourselves in the fund from a specific region before we get very active in investing in startups in a specific region. And that's because we like to deputize our LP investors and have them tell us which startups to engage with and have them come through that trusted network. So in terms of a sequence, yes, we are interested. We are accepting investors for our own fund too. And we would welcome to have representation from the Middle East region in that fund. And then we would hope that those same investors could help us, avoid boiling the ocean and focus in a more discrete fashion on a smaller number of startups that we could support within the region.
Eric, a question for me. If you were looking to invest in startups in the region or include them in your fund, what would you be looking for? What would your criteria be, or what would your advice be to startups in the region?
We would use the same criteria that we use anywhere, which is we're a relatively small fund. We think that earlier stage and smaller investments tend historically to have higher return. So we want to find companies when they're still young, and we look for applied AI. And we like to see companies that either have or could catch the attention of our corporate partners. So those are criteria that we apply everywhere and that we would apply in the Middle East as well. One of the additional elements that we would bring to the Middle East is that even if we tend to invest early when the company is still young, we would really think through who are the logical investors for when the company gets older. I think one of the challenges in many geographies, and including the Middle East, is that they are better at getting early stage investors than mid-stage investors. And so that's, you know, we would want to know whether we would create an opportunity to introduce a startup to the type of mid-stage investor that we could hand off the investment to. But where we see a lot of challenge around the world is more firms writing early stage checks, fewer firms writing mid stage checks, and we'd want to understand how that evolution might work out for a company before we would invest even early stage.
And Eric, for corporates who might be thinking of investing in VC, what's your advice to them? Are there specific sectors? How should they go about it if there's an interest?
Well, corporates, I think every corporate is different. Some corporates have financial objectives, some have strategic objectives. When we sometimes get involved in coaching or advising corporates which are in the process of establishing a corporate venture arm, once a corporate has a venture arm, they tend to have a pretty fixed idea of what they want, and we do more listening than talking. And we have spoken with, I think, about 80 corporates in the last quarter just to understand their own investment thesis so that we can figure out which subset of our existing portfolio companies and prospective portfolio companies we can introduce that corporate to. We have 21 portfolio companies currently. When we speak to a corporate, we usually listen to their thesis and identify which 3 or 4 of our companies we should tell that particular corporate about. So we really view ourselves as a matchmaker between startups and corporates that may not know about that startup, but that startup may intersect with the corporate's own thesis. Some are early stage, some are mid stage, some are looking only for businesses that match a current business unit of the corporate. Other corporates look more broadly at technologies which could be part of launching a new business unit. And we just work to understand what each corporate objectives are and then bring them to startups that intersect those objectives.
That's great. I think there's one question, but I think I would suggest that we take that offline. It's about endowment risk, Eric. I don't know if that's a topic that you want to respond to. If not, we can take it offline. And
well, I'd love to understand the context. I think that can mean a couple of different things, and I would do better at answering it in a dialogue.
I will put you in touch with that. So I think that we could, gentlemen, probably wrap up now because we're coming to our 12 o'clock deadline here. But perhaps it would be good, Eric, if you wanted to just sum up or say a few words, and maybe Jack and Vinay and our speakers, if you just want to add a last word, and we'll go around. So maybe Eric, we'll start with you.
Well, you know, I would just say that I think this has been a productive conversation. I love the dialogue and the chance to really, the heart of it is the Q&A and the breakout sessions. We at Impact look at applied AI, but we see that AI being applied a lot in the fintech space, and fintech is a particularly common sector in the Middle East. I think a higher percentage of startups are in the fintech space in the Middle East than anywhere else in the world. And so we're excited to be part of that intersection. You saw from the Good AI panel all the different directions that AI can take. And we try to take that and partner with corporates to find the most promising investments. I think that the Middle East has really made tremendous progress over the last handful of years at removing some of the historical barriers to innovation. And I think the fact that you've seen as much activity in the first half of 2020 as in all of 2019, despite COVID, really shows the rapid growth curve that the Middle East is on. So those are my observations from the day, and I'll defer to others who might have parting thoughts as well.
Jack, do you want to say a last few words, and any of your panelists?
Sure. I just close by saying I'm grateful for the opportunity to connect with everybody. I think what we're working on together and what we're talking about is very important. We've created a unique opportunity to bring together global experts and have important discussions about innovations that could literally impact 1 billion people. And if you want to create a company worth $1 billion, then why not go, look at a solution that positively impacts 1 billion people? So I'm grateful to BDI and to APCO. This is a great collaboration, and I hope it's the first of many as we look at sort of cross-border strategies that exchange information and experiences between investors, between entrepreneurs to create valuable companies. So thanks so much for the opportunity.
Michael, Gordon, John, would you like to say a last word?
Well, I thought Eric's presentation was fascinating. A key takeaway for me was that fact about 80% of the US companies were down after COVID, 20% were massively up, and this could be something to do about remote working and the changes. This could, the opportunities for investment after a downturn in home working. These are all thoughts that I had listening to Eric. So I had a lot of takeaways from all the speakers. Just a really, really fascinating conference. Thank you so much for inviting me.
Thank you, Michael. Gordon?
I just wanted to thank everybody as well. It's been awesome. I really appreciate the opportunity to talk with everybody. And it was amazing the interest level that everybody had. It's really fun. Thank you.
Pleasure. And Suresh? Have we lost Suresh? Or is he on mute? Maybe we've lost Suresh, but never mind. I think that we will close now. I just would like to say thank you again to APCO. I'd like to say thank you again to VC Impact and to the GCC BDI team who've set this up. We will have a last networking break. I know we're late. I'm going to close for those who have to go officially, but if anybody wants to stay on, we're going to offer a last networking break, maybe in plenary like this. We won't go into smaller groups, but if anybody has questions, I'm sure that Jack and Eric and the speakers would be happy to stay on and just continue the conversation. But for those who thank you very much for joining us today. We'll send you a copy of the slides. We'll send you a copy of the contacts for VC and for the speakers. And if you have any questions that we didn't answer, just send us them by email and we'll get back to you. But right now, if anybody's got any other questions they'd like to ask, please feel free. I think Jack and Eric will stay on with us and the other speakers for a little while.
Happy to.
Vinay, I know you have to leave. Thank you very much indeed for being with us today, Vinay.
Thank you, everyone.
Thank you, Jane.
Pleasure, Stefan.
Thanks.
Thank you.
Amjad, you just joined us. I don't know whether you had any particular interest or questions that you wanted to ask.
Not really. I'm sorry, me? Oh, no.
Yeah. Amjad. I think that's...
thank you. I was a bit late.
Don't worry. Was there anything you particularly wanted to ask Amjad or talk about? Or what's your interest particularly?
Not really at this time because probably I've missed the whole discussion, but maybe in the next one.
Don't worry. You missed an interesting discussion. Asya, from your perspective, you're on mute. You're very much into venture capital. What's your views? You're on mute, Asya. You're on mute.
Thanks to all the participants and the panelists on this interesting topic. And this is definitely the way moving forward. I think we're moving away from the traditional way we work in venture capital, and the industry will be dominated more with AI and machine learning. So this is definitely the way moving forward. And thank you very much for BDI and APCO for this interesting event.
Thank you, Asia. She's based in Bahrain and with venture capital there, so interesting perspectives also. Do you see Bahrain moving ahead in this field, Asia?
Yes, yeah, we have a special center here for fintech that is supervised as well by the regulators in Bahrain, by the central bank, and I see Bahrain as a financial center moving towards this direction for sure.
Yeah, I think there's a lot of competition in the region about who wants to be the fintech or the innovation hub. There's an awful lot of work going on here in Dubai and the UAE in general. I know that Saudi is very keen on this, and Bahrain has been for some time. So and that sort of regional competition is healthy as well, I think.
Yeah, definitely. Yeah, this is I think the competition in the GCC between Bahrain and Dubai and Saudi is really healthy towards having a better culture in fintech and AI.
So I think if we've got no more questions, we will wrap up. I just thank you again to Jack, Eric, Michael, John, everybody who's been on the panel with us today. Gordon, thank you so much. It was really, really very interesting. And I think that we could think about doing a follow-on maybe next year in terms of maybe a few other topics and see how, how it goes on, maybe even after post-COVID, if we ever get post-COVID, that would be great. Thanks, everybody. I'm going to say goodbye now, and thank you very much for being with us. Take care. Bye-bye.
Good job, Jane.
Thank you all. Goodbye.
Thanks.
Bye.
Bye-bye,
Thank you.
everyone.
Thank you, Jane. Well done.
Pleasure.
Thank you. That was amazing. Thank you.
Nice to see you, Alberto.